Prediction Markets and the California governor race, investigating manipulation claims. Last updated, June 1, 2026. Executive Summary. Is there any factual basis for claims that a campaign, e.g., Xavier Becerra's, is secretly funding trades on Kalshi and Polymarket to boost one rival, Steve Hilton, and suppress another, Chad Bianco? Based on current evidence, the answer is no. There's no credible, documented proof that Becerra's campaign or any political actor orchestrated such a scheme. The patterns you've observed, like Hilton's odds rising when Bianco's stay near zero, are readily explained by how prediction markets function. CNBC. Prediction market mechanics naturally create inverse price movements between mutually exclusive candidates because probabilities must sum to 100%. If one candidate's chance goes up, others will, by definition, go down. Kalshi. Long-shot candidates often show flat, suppressed odds simply because few people trade those outcomes. Minimal liquidity can cause their price to remain stuck near the floor, e.g. $0.003 per share, representing 0.3% chance, for long periods. In other words, a near-zero price doesn't require a conspiracy when hardly anyone is buying those shares. Predict market cap. +1. Regulators and platforms have stringent rules banning insider trading and market manipulation. Kalshi explicitly prohibits candidates, staff, or those with inside knowledge from trading on their own elections. Both Kalshi and Polymarket have stepped up surveillance due to real cases of insider trading, such as an army officer illegally betting on a classified military operation, but no analogous cases have emerged involving the California governor's race. Kalshi. CNBC. +1. Alternative explanations like market consensus, poll interpretations, and trader behavior can fully account for the inverse movement and low odds without invoking secret manipulation. For example, if traders believe Bianco's path to winning is extremely unlikely due to his lower poll numbers and California's partisan lean, his odds will stay near 0%, regardless of minor poll fluctuations. Meanwhile, Hilton's slight rise in market odds over time reflects his consolidation of Republican support and a plausible top-two finish, though his overall winning chances remain low in a deeply Democratic state. Polymarket. LAMIG. +1. Below, we present a comprehensive analysis addressing each aspect of your question, the fundamentals of prediction market mechanics and cross-platform arbitrage. 1. Real price/volume data from the California governor markets. 2 and 3. The distribution of liquidity and its effect on long shots. 3. Platform rules and known instances of insider trading or manipulation. 4 and 5. The robust regulatory oversight currently in place. 5. Psychological and structural alternative explanations for the observed patterns. 6. And what it would take to prove a genuine manipulation scheme. 7. All factual claims are backed by credible sources, including platform rules, news reports, regulatory documents, and academic or industry analysis. 1. How prediction market mechanics work: odds, order books, and arbitrage. Prediction markets are not like traditional polls or fixed betting odds. They are peer-to-peer exchanges where traders continuously buy and sell shares of outcomes. The price of a yes share roughly corresponds to the implied probability of that outcome, since each share pays $1 if the outcome occurs. For example, a yes share priced at 74 cents means the market's consensus probability is about 74% that the candidate will ultimately win. KQD. Key mechanics include mutually exclusive outcomes and zero-sum probabilities. In a winner-take-all election market with multiple candidates, the sum of all candidates' probabilities is constrained to 100%. This means if one candidate's odds rise, other candidates' odds automatically fall proportionally, an inverse relationship, even with no malice at play. For instance, if traders start buying Steve Hilton shares, anticipating improved prospects, pushing his implied probability from 6% to 10%, the combined probability allocated to other candidates must drop by 4 percentage points. This inverse movement is a normal consequence of the market math, not necessarily evidence of targeted suppression. Every yes buyer is matched by a no side seller or vice versa, and the two sides' prices always sum to roughly $1 or 100%. Kalshi. DeFi rate. +1. Order book dynamics. Both Kalshi and Polymarket use continuous order books where traders place bids, buy offers at a certain price, and asks, sell offers, for contracts. The best ask, lowest price someone is willing to sell a yes share, sets the market price for that outcome at any given moment. If trading is thin, few active orders, the market price might not change for hours or days. Compare this to a polling average. A poll number changes only when new data arrives, and similarly, a prediction market price only moves when someone places a trade. In a lightly traded outcome, price movements can be infrequent and small, making charts look unusually flat. DeFi rate. +1. DeFi rate. KQD. +1. Market makers and incentives. Early in a market's life or for very low probability outcomes, special traders or algorithms, market makers, often provide initial liquidity to seed the order book so others can trade. Kalshi and Polymarket each offer maker fee rebates or rewards to encourage traders to place limit orders and maintain tight spreads. Even so, less popular outcomes can have wider spreads and shallow depth, few contracts available at each price, meaning any significant order could easily move the price or face higher slippage costs. CNBC. +1. MarketMath. +1. Cross-market arbitrage. The existence of multiple platforms, Kalshi, Polymarket, others, trading the same event helps police extreme price disparities. If one platform's odds deviate significantly from another's, e.g., Hilton at 15% on Kalshi but 5% on Polymarket, traders can execute arbitrage, buying low on one and selling high on the other, to profit until the prices converge. This arbitrage mechanism tends to limit the ability to sustain any artificial price manipulation on a single platform, since such gaps invite other traders to exploit and erase the discrepancy for profit. Bottom line, prediction markets reflect the collective beliefs and capital of traders in real time. Their design, with zero-sum probabilities and isolated order books, can explain patterns like one candidate's rise correlating with another's decline without needing a coordinated effort behind the scenes. Thin markets with limited liquidity can produce sticky prices that barely move, especially for long shots, unless or until traders see a reason to adjust them. 2. Real price history and odd movements in the 2026 California governor race. The California Governor 2026 race has been a high-profile event on both Kalshi, a regulated U.S. exchange, and Polymarket, a global crypto prediction market. Here's a snapshot of recent odds and a comparison with recent poll standings. Candidate Party, May 14th to 18th poll support. PPC poll likely voters. Yahoo. Polymarket odds. Implied win probability as of June 1, 2026. KQD. +1. Kalshi odds. Implied win probability as of June 1, 2026. KQD. +1.
Xavier Bassarra, D, 23%, un ST, 7,4 i 7,2.
Steve Hilton, R, 20%, second, 6%. Polymarket. 10%. Kalshi. Tom Steyer, D, 15%, third, 16%. Polymarket. 17%. Kalshi. Chad Bianco, R, 13%, fourth, less than 1%, 0.3%. Polymarket. Less than 1% is almost equal to 0.5%. Katie Porter, D, 12%, fifth, less than 1%, 0.2%. Polymarket.
1% est approximativement égal à 0% et.
Table 1. Poll standings versus prediction market win probabilities recent data. The polling figures, mid-May 2026 PPIC survey, show a close multi-way primary. In contrast, both prediction markets signal Becerra as the overwhelming favorite, is almost equal to 75% chance to be the eventual winner, with Steve Hilton a distant second, 10%. Tom Steyer around 15 to 17%, and Chad Bianco effectively 0%. This disparity, especially Bianco's near zero odds despite polling 13%, is not unique to any one platform. Kalsher and Polymarket broadly agree on these rankings. KQD +1. KQD +1. Notable price movements and patterns in these markets over recent months generally align with news events and the top candidates' fortunes. Xavier Becerra's rise. Becerra's market price was not always 75%. In fact, as recently as March, April, Becerra's odds were much lower, reportedly in the single digits, when other candidates still crowded the field, e.g., Representative Eric Swalwell was a leading contender at the time. Becerra's steady, but small, lead in polls grew only in late spring, and his odds gradually climbed as traders perceived increasing momentum for him heading into the June 2nd primary. The markets reacted strongly when Swalwell withdrew amid scandal in early April. Becerra's chances surged to fill the vacuum left by Swalwell, consistent with Becerra's jump in subsequent polls. These increases in Becerra's price followed clear campaign developments, high-profile endorsements, positive polling, rival exits, rather than unexplained leaps, pointing to information-driven trading rather than manipulation. LAMIG. KQD. KQD. +1. LAMIG. +1. Steve Hilton's sustained, but limited support. Hilton's market odds have been relatively stable in the mid-single digits, rising slightly to 10% on Kalsher in the final days before the primary. This tracks with polls showing Hilton consolidating the Republican base vote and edging ahead of Bianco as the leading GOP contender. However, traders appear to price in California's strong Democratic lean, limiting Hilton's chances of ultimate victory even if Hilton makes the top two. The infrequent upticks in his price coincide with favorable news, e.g., being endorsed by former President Trump, and new polls confirming his position as the likely GOP nominee in the top two primary. Still, these lifts for Hilton are modest, reflecting the consensus that a Republican win in November remains an uphill battle. Kalshi. LAMIG. +1. Yahoo. +1. Yahoo. Chad Bianco's flatlined odds. Bianco's implied probability to win has hovered around 0.3 to 0.5% on both Polymarket and Kalsher for weeks, barely moving even as polls briefly showed Bianco with double-digit support. This suppressed price pattern is typical for a long shot in a multi-candidate field with a top-two system. Traders effectively see Bianco as extremely unlikely to both reach the general election and then win it. Even if Bianco had a modest chance to grab the second slot in the primary, he'd still face a very low probability of beating a Democrat in November. Thus, from a market perspective, Bianco's overall win probability stays near zero, and there's little reason for traders to bid up his shares beyond a few tenths of a percent. Predict market cap. +1. Yahoo. Polymarket. Notably, Bianco's shares have attracted over $1.5 million in trading volume on Polymarket, suggesting that traders have indeed speculated on him, likely early on when odds were a bit higher. But because California's fundamentals make a Bianco victory so remote, any small bursts of buying interest met quick selling pressure from skeptics or arbitrageurs. The result is a flat chart near the 0.2 cent, 0.3 cent price floor, except for negligible blips that soon revert. Polymarket. Key takeaway. The inverse movement and persistent difference in Hilton versus Bianco odds are consistent with an evolving market consensus that Steve Hilton will likely finish ahead of Bianco in the primary, but still has a low chance to ultimately win, whereas Bianco's path to victory is essentially non-existent. This dynamic inherently means traders allocate nearly zero probability to Bianco and some modest probability to Hilton, implying Hilton as the token GOP finalist, a scenario that looks like one candidate's odds are bidding down the others, but in reality it's the natural interplay of a competitive primary in a heavily one-sided electorate. 3. Liquidity and long-shot candidates. Why long odds can remain flat. Another critical factor behind Bianco's suppressed odds is liquidity, the amount of trading interest in a particular outcome. Prediction market liquidity is often highly uneven. Most of the money flows into the top outcomes, while minor candidates see far fewer trades. Predict market cap. +1. On Polymarket's California Governor Market, the total trading volume across all 23 candidate outcomes has exceeded $29 million. Yet that activity is heavily concentrated. For example, Steve Hilton and Xavier Becerra alone account for a significant slice of trades, while each of the many long-shot candidates, Bianco and others polling in single digits or lower, reflects roughly $1 million or so in volume each. Kalshur reports a similar concentration, with millions in its California race market by late February, mostly focused on top candidates. Polymarket. +1.
Político.
Thin markets lead to static prices. If few traders are active in Bianco's contract, the price can stay flat simply because no one is placing new orders to move it. Once Bianco's odds fell to essentially 0.3%, he entered a zone where only a large sustained buy could lift his price above that floor, since many traders are likely willing to sell or short Bianco at anything close to 1% as a profitable bet that he will lose. In effect, the order book for Bianco is probably dominated by sellers eager to take the other side of any optimistic bets, thus capping any upward moves. KQD. +1. Market makers and arbitrages enforce low odds. If someone did try to bid up a clearly losing candidate like Bianco by pumping money into his yes shares, they'd likely incur losses. Other traders or automated market makers would rush in to sell Bianco shares at inflated prices, knowing the fundamentals don't justify it. This arbitrage dynamic means that any attempt to artificially raise Bianco's odds would be expensive and temporary, as the price would revert once the buying pressure relents, costing the pumper money when Bianco eventually loses. This is a major deterrent against strategic manipulation. Manipulators lose money to the market unless they have extremely deep pockets and are willing to burn cash for perceived political influence.
Político.
+1. In summary, the combination of inadequate liquidity and rational skepticism about a long shot's chances can naturally produce the kind of suppressed, flat price chart seen with Chad Bianco's odds, no secret funds required. 4. Insider trading and market manipulation, platform rules and known cases. Both Kalshur and Polymarket explicitly ban insider trading and manipulative conduct in their rulebooks. For instance, Kalshur prohibits any candidate, campaign staff, party officials, or others with a direct influence on the outcome from trading on related markets. These rules aim to prevent the exact scenario you hypothesized, candidates or their allies covertly using money to skew market odds. Kalshi. +1. Enforcement has been active in ensuring market integrity. Candidate self-betting. In early 2025 and 2026, Kalshur detected multiple instances of political candidates betting on their own elections or other related outcomes, a clear rule violation. These traders were swiftly sanctioned with suspensions and fines. For example, one political candidate was caught placing bets on his own gubernatorial race, leading Kalshur to impose a 5-year ban and financial penalty. Another case involved a trader affiliated with a YouTube channel who traded on a contract tied to that channel's content, leveraging advanced knowledge. This person was fined over $20,000 and suspended. CFTC. +1. CFTC. Major donor incident. In February 2026, Stephen Klebeck, a prominent Democratic donor and former candidate, attempted to bet $1,000 on his friend Eric Swalwell and against another candidate, Matt Mahan, on Kalshur. Kalshi's compliance team promptly blocked Klebeck's trades and suspended him from that market, first reported by Politico. This underscores that platforms actively monitor unusual trading behavior, especially from politically connected individuals.
Político.
+1. Insider information abuse. Perhaps the most dramatic case to date is not about manipulating odds for perception, but profiting from secret information. In a headline-grabbing example, a U.S. Army Special Forces sergeant was arrested in April 2026 after using classified intel about an impending military action to bet on Polymarket, netting $400,000 in profit. The CFTC filed a civil enforcement action, its first insider trading case in event markets, while the Department of Justice launched a parallel criminal prosecution, illustrating how seriously authorities treat illicit trading on these platforms. CNBC. +1. Lowenstein. +1. Key insight: none of the known enforcement cases involve coordinated market manipulation to boost or suppress election odds for political gain. They do show that prediction markets are being policed for integrity issues. Candidates trying to bet or insiders trading on non-public info have been caught and punished. If a campaign were systematically funneling money to distort odds, it would violate multiple laws and rules and likely trigger similar alarms and response from the exchange or regulators. Indeed, the House Oversight Committee recently demanded that Kalshur and Polymarket provide data on how they detect anomalous trading activity that could indicate manipulation. So far, no such case has been publicly reported in the California governor contest. CNBC. +1. 5. Regulatory oversight and investigations, CFTC and lawmaker actions. The expanding popularity of prediction markets has brought increasing regulatory scrutiny. Both federal regulators, like the CFTC, and lawmakers are closely watching for signs of market manipulation or insider trading. Below is a timeline of key regulatory actions and developments relevant to prediction market integrity and political event bets. Regulatory agencies are clearly attuned to the risk of both insider trading and market manipulation in these markets. They recognize that, in theory, a wealthy actor could attempt to distort odds to mislead the public or profit from misinformation. For example, academics studying in Trade's 2012 presidential market found that a single trader spent over $4 million buying Mitt Romney shares in thousands of small transactions, apparently to inflate Romney's odds for political purposes. This underscores that attempts at manipulation have historical precedent in prediction markets.
Politico.
+1. However, it's important to note that the current oversight environment is far more stringent than a decade ago. Kalshur, being fully regulated, must maintain robust surveillance and report suspicious trading patterns to the CFTC, per federal law. Polymarket, after a 2022 settlement, has also enhanced compliance for U.S. users while its global platform remains partly outside U.S. jurisdiction. Lawmakers are pushing for new rules that would explicitly outlaw any trading by politicians or insiders and even prohibit betting on elections entirely. CFTC. CNBC. Lowenstein. +1. Net effect: if a campaign or political figure were secretly dumping funds into these markets to sway the odds, they'd face significant legal risk and a high chance of detection. 6. Alternate explanations for irregular patterns. The observations you cite, inverse odds movement and a flat chart for Bianco, have plausible non-nefarious explanations. Inverse moves reflect competition, not collusion. Prediction markets for elections function like multi-way seesaws. If one candidate's side goes up, another's goes down. This is especially apparent among candidates competing for the same political bloc or a limited set of advancement slots, as in a top two primary. Here, Hilton and Bianco are both Republicans vying for one likely general election spot. As Hilton gained momentum, via endorsements like Trump support, and pulled ahead of Bianco in polls, traders shifted probability from Bianco to Hilton. This would naturally appear as an inverse relationship, but it's expected in a zero-sum scenario. It doesn't require that anyone is deliberately bidding down Bianco's odds. Traders simply see Bianco's chances diminishing as Hilton's improve. Lameg. +1. Suppressed, flat odds are normal for extremely low probability outcomes. In thinly traded tail-end outcomes, the last traded price often sticks at a minimum level until compelling new information arrives. Bianco's public support may seem decent on paper, 13% in one poll, but from a long-range view his chance to win the governorship is close to nil. Traders consider not just whether Bianco can get into the top two, but whether he could then win a November election in Democratic majority California, a very tall order. Thus, the rational expected value of a Bianco win remains near zero, causing his contracts to languish around their lowest price tick. Not an irregularity, but actually the market's consensus that Bianco's minuscule probability is largely unchanged by routine events. Only extraordinary news, e.g., a major dropout favoring Bianco or a dramatic shift in the electorate, would prompt enough trading interest to break him off the floor. KQD. +1. Herd behavior and cognitive biases. Markets are made of people with their own biases. Researchers note that traders often overreact to minor news and underreact to major shifts. This can create short-term volatility in the odds of higher-profile candidates as traders chase the news cycle, while causing sustained underestimation or neglect of less prominent contenders. In other words, even if Bianco had an outside shot, traders might systematically overlook it due to psychological biases, mistakenly treating his early polling lead as a fluke or focusing on the more media-visible candidates. Such behavioral factors can produce inefficiencies and wrong odds without malicious intent. KQD. +1. Bottom line. The simplest and most evidence-backed explanations for these patterns are rooted in how prediction markets operate and how traders behave, not in covert campaign funding conspiracies. 7. What would constitute credible evidence of market manipulation? Finally, let's consider what it would take to determine that a campaign is manipulating a prediction market. Given current information, we have no direct evidence of such in this race, but hypothetically, signs of manipulation might include unusual trading patterns not explained by news or polling, e.g., large sudden bets that significantly shift odds without any new information, followed by quick reversion, suggesting artificial pumping. Detecting this requires detailed trade logs or data analysis beyond what the public sees. So far, no reputable analysis of the California market has reported such anomalies unique to Bianco or Hilton's odds. Linked accounts or known associates executing coordinated trades. For instance, if multiple new accounts all started heavily shorting Bianco at the same times that others heavily bought Hilton across both CalSure and Polymarket, and these accounts were traced back to related sources of funds, that would raise eyebrows. However, both platforms implement KYC, Know Your Customer, checks, especially CalSure, and monitor for anomalous trading activity for exactly this reason. CNBC. Insider whistleblowers or leaked communications. Short of technical forensic evidence, actual proof of a campaign-driven scheme would likely come from someone involved coming forward or documentation showing orders to manipulate markets, akin to catching a campaign instructing supporters to trade in certain ways. No such revelations have emerged, and it would be a serious violation of regulations if they did. Regulatory findings or media investigations. Government bodies like the CFTC have sophisticated surveillance and subpoena power. If a campaign were orchestrating trades, it might leave legal or financial traces. Law enforcement could detect suspicious flows, similar to how they identified trades placed shortly before geopolitical events by certain Polymarket users. As of now, neither the CFTC nor news outlets have reported any suspicious trading tied to specific California campaigns. CNBC. Given the oversight environment detailed above, it's unlikely such a scheme could remain hidden for long if it were significantly influencing market prices. In practice, any attempt to manipulate these markets on a large scale would be risky, expensive, and likely self-defeating. Table 2. Illustrative metrics on potential manipulation efforts. Left. Roughly how much capital a manipulator might need to noticeably distort odds in a major market for an extended period, a costly endeavor that others could easily exploit via arbitrage, meaning the manipulator loses money. Right. Number of Polymarket accounts flagged for suspicious trading patterns, as identified by a recent investigative report, signifying increased scrutiny of any abnormal activity. CNBC. Conclusions. Overall, there is no factual support at this time for rumors that Xavier Becerra or any campaign is secretly funding trades to prop up Steve Hilton's odds or hold down Chad Bianco's price. The structures of prediction markets and public information readily explain the observed trends, a natural zero-sum rebalancing of probabilities, and a consensus that Bianco's chances are effectively nil. The burden of proof for a manipulation claim would be high, and neither platform data nor regulators have indicated any evidence of such activity in this case. Instead, the evidence suggests that what you see in CalSure and Polymarket for the California governor's race is simply the wisdom and whims of the crowd at work. Traders are reacting to polls, news, and each other's behavior, which can produce counterintuitive patterns, like flat lines or seemingly coordinated movements, without any covert interference. Regulators and exchanges remain vigilant for any genuine wrongdoing. But absent concrete evidence of a coordinated effort, the safest interpretation is that the prediction markets are reflecting traders' genuine beliefs, even if those beliefs might sometimes be flawed or skewed by biases. KQD. In short, the inverse moves and suppressed odds you've noted are very likely the result of normal prediction market dynamics, not a clandestine campaign ploy. Any credible claim of manipulation would require solid evidence that simply isn't there at this point. CNBC.